You stress that tax planning might be a little more important to monitor during retirement than during the working days. Why is that?
Well, I think during your working days, Kamie, you don't really have a choice.
You don't.
Once you retire, you can control to a certain extent how much taxes you are going to pay. Welcome back to another edition of Retire and Thrive, where we help you live your life with purpose, wealth, and confidence.
Yes, I'm Kamie. This is Dan. We hope you're having a great start to your fall. We thank you so much for joining us for another edition of, I guess, just learning about finances. And this week we're talking about taxes, which to me can be intimidating. Sounds like it's something that can be intimidating. Sounds like something that you always are just paying, and maybe you're not really fully sure how important it is to monitor when you're paying taxes and how much you are being taxed. How are you, by the way, Dan?
Everything's great. Yeah, we're getting close to Halloween, so that's just around the corner. It's hard to believe that.
Yes, well, it feels like Halloween is like a 3-month thing now because, after 4th of July, they start putting out the Halloween decor in the stores?
I was at a box store yesterday, and same thing. They actually had Christmas stuff out. And I made that comment. I said to the guy in the store, I said, well, I can't even find what I'm looking for because there's all this Christmas stuff. And he says, well, we operate in 3 seasons this time of year. So I guess that's what they go with.
That's how it works. That's how they make their money. It's all about that money, right, Dan?
Yeah.
So let's talk taxes. Where are we starting today? Because it just seems like such a broad topic.
It's very broad.
What would you like to start with?
So this is, we've moved away from lesson 5. We're now on lesson 6.
Social Security.
Yeah, now we're talking about taxes. So we're doing a big shift here.
Yeah.
And it's, as you indicated, it's very, very broad. And so we're going to kind of narrow that down, and we're going to dive into, again, we'll focus a little bit on the more on the retirement side. Mm-hmm. But again, as I talked about last episode, if you want to come at it a little bit more from, the accumulation phase, we can certainly talk about that.
Yeah.
We never have a specific time that we've got these limited, but I did get an email the other day that I did want to share with you and with the viewers. We get emails and we get comments below, but when I thought about this podcast, it's been on my radar for at least a year. Mm-hmm. The book came out in a little over a year ago, and I've wanted to do a podcast. And as I said last time too, you're just a great fit for this, asking the inquisitive questions. But my main purpose was I was hoping that we could help people make good decisions. And what I wasn't necessarily expecting was the implications that we're having. And some people just don't verbally talk about it. But I do want to read you this email because I think it really hit home with me.
Oh, awesome.
And this email, like I said, just recently came in. And I'm going to just literally read it verbatim here. It says, "Hi, Dan. I've been watching your podcasts about retirement and really enjoying them. My husband and I have been talking about what will give us joy in retirement." And if you remember, that goes back to lesson number 1, enjoying the fruits of your labor. And she says, "I am fully retired since the spring. My husband is now part-time and has 10 weeks of vacation per year. Your podcasts have really inspired us to think about what is important and how do we want to spend our money. We've decided to book a large cabin in Wisconsin every year, invite all 5 of our kids and their kids. We are currently here," so they obviously were at the cabin when this was in her mind, "and we're with one of our older sons and their 10-year-old daughter, and we are having a blast. We," meaning her husband and her, "pay for everything, and we will rebook every year going forward." Then she goes on to say, "We also own a 1-bedroom timeshare with 4 weeks in the Caribbean for the month of March." So the whole month of March, apparently they've got a timeshare in the Caribbean. "In 2026, we have invited 4 of our kids and their spouses and their kids to join us. We will have a few of them with us each of our 4 weeks. The accommodations and plane tickets are their Christmas gift from us. They are all excited, and I'm in the middle of getting everyone booked. Just know that your podcasts are inspirational. They have made us think about our future. We want to spend some of our money on, quote, experiences with our kids and grandkids while we are still young and healthy." Then she says, "P.S. Thanks for making us think about what really is important to us as we age."
That's fantastic.
And I have to be honest, I got a little emotional when I read it.
Yeah. But that's really what this podcast is all about, helping others thrive. That's truly what it is. But also, just listening to that, it's like, for those who are fortunate enough to have family members loved ones that are around that they can spend time with. That's pretty special.
Yeah. And I love the part where she said, we're going to focus on experiences in quotes. And it's like, you hear it all the time, but, people get to their point in life where, maybe they've just, maybe they're in a skilled nursing facility or whatever, and they just talk about the people they've met and the lives that they've been involved in. So it is really about relationships. It's not, I know we get granular here and we get into, now we're going to be talking about taxes.
Right.
But those do have implications. And so, from my lens, I always think of what's the most efficient way that we can either minimize taxes or maximize Social Security benefits.
Yes.
But I think this also was a reminder to me is let's not forget about what we're here on this earth for, and that is to live life to the fullest.
Yeah, and hopefully these podcasts help you live life to the fullest and educate you so that you can get there, so that you're able to do those things and have those experiences. Fantastic. Thanks for sharing that.
Yeah.
It's fun.
All right. We're going to do a quick 180. We'll talk about taxes now.
Oh, yes. Now we're talking about taxes, okay? So you can have the fun and you can do things correctly. So, Dan, you stressed that tax planning might be a little more important to monitor during retirement than during the working days. Why is that?
Well, I think during your working days, Kamie, you don't really have a choice. I mean, you're kind of, I hate the word stuck, but you are kind of stuck.
Doing the money and you do it.
I mean, really the only thing you can control, obviously you can control your wage based on jobs you take and businesses you may or may not start, but you're going to pay what you pay.
Yeah.
And there is not a lot of control once when you're in your working years. You can control, about the only thing that you can really control when you're working is how much you're going to contribute to your retirement plan pre-tax to reduce that income.
Right.
But outside of that, you don't really have a lot of control. You get to be retirement age, you have a complete, literally like a blank canvas, and you can create whatever it is that you want in terms of your tax scenario. And there are certain steps that you can take to minimize them, but there's always this trade-off. And the trade-off is, do I pay taxes now or do I pay taxes later?
Right. So how do we make these decisions? How do we know what to do once we hit that retirement age?
It's one of my least favorite phrases, but it depends.
Yeah. It's complicated.
It's complicated, and it does depend. But let's just kind of peel back the onion for a minute here, and let's just kind of start with kind of the basics.
Okay.
I think first you start with what income sources come in the door no matter what. We oftentimes refer to those as guaranteed income. And those guaranteed incomes could be, as we talked about the previous 3 episodes, it could be Social Security, it could be pensions, not necessarily guaranteed, but it could be rental income, it could be dividends if you own individual stocks, it could be portfolio income. So those are income that is going to be coming in the door or coming into your bank account consistently.
Can I just stop you for 1 second? When you say portfolio income, what specifically are you talking about?
Yeah, so portfolio income would be is if I've got a portfolio of mutual funds or exchange-traded funds, they may kick out a capital gain or they may kick out a dividend. So if we take a look at a company, for example, none in particular, but companies, when they make profits, they can typically do one of 2 things, Kamie. They can take that profit and they can pay it out in the form of a dividend or a portion of it, or they can take that profit and reinvest it back in the company and not declare or pay a dividend. And by doing that, that determines the taxability of their profits. So a lot of your technology companies don't pay dividends because they're reinvesting back in their company. But if you take larger banks or oil companies, they often pay a pretty healthy dividend. So a mutual fund would just be a pool of those. And so you don't necessarily have control of how much that is. You can invest in investments that kick out more income and maybe are geared more towards what we call more value-oriented, like a large cap value that includes some of those banks and oil companies, or you can invest in more of the technology that doesn't pay much of a dividend. But what I'm getting at is that if you've got a portfolio of mutual funds or individual stocks, that income is coming in and you can't turn it off. That's probably a better way for me to phrase it. So Social Security, pensions, if we've elected the monthly income, you can't just turn it off. It's going to come in whether you want it or not.
Okay. So we're looking at all of this.
Yeah.
We're unpeeling this onion.
Yep.
So that's our first step, looking at all those revenue streams that we've had and sources of income, I guess. And then what?
And then I think to go back to kind of the basic 101 with financial planning is we take a look at all of that income that's coming in, and then let's figure out what we're spending. And there's always two sides to the spending. It's always, well, this is what my necessities are, which is my utility bills, and if you happen to have a mortgage or a car payment or whatever, any other type of debt that you might have. But then we also factor in what are some of the niceties. It would be nice for us to travel.
Yes.
It would be nice to get a new car. It would be nice to help our grandchildren with college or whatever's important to them. So we build those in. And so when we start kind of building out this budget, if you will, then what we do is we take a look at that and then we match it up and see what those income sources are. So you know me, I like to use examples.
Mm-hmm.
So if we've got income coming in that's $6,000 a month between pensions and Social Security, and we've got expenses that are $8,000 per month, we've got a deficit there of $2,000. Then we go and we take a look at where are we going to get that $2,000 deficit from. And that could be from any number of sources. And so, again, my analogy, peeling back the onion, we go back and we start looking at that, and it's like, okay, we've got the income sources coming in, we've got this deficit of $2,000, and pretty much everything can be broken up into three different tax statuses or tax types. Let me refer to as tax types. The first tax type would be non-retirement money. This would be money that you've already paid tax on. What we call, kind of a jargon in our industry, we call it non-qualified assets. Qualified is associated with retirement accounts. This is not a retirement account. So think of it as it's after-tax money. You can take it anytime you want, whether you're 40 years old or if you're 65 years old. Their tax has already been paid on it. I take $100,000, I invest it in a stock. It goes up to $120,000. My initial $100,000, I've already paid tax on it.
Mm-hmm.
So, or I could be sitting on $50,000 at the bank. That's considered non-retirement, non-qualified after-tax money. The second type of tax status is going to be retirement accounts. And so that would be, for example, if you work for an employer, you've got a 401k, you retire, you roll that over. If it's pre-tax, Kamie, every dollar you pull out of there is 100% taxable. It's treated as ordinary income. What's ordinary income mean? Just like your wages. Just gets tacked on top of that. So we've got non-retirement, then we've got retirement, and then the third component, which I get very happy about, and that's that Roth IRA. And the Roth IRA is you've chosen to pay tax on that in some form, but then whatever it grows to, as long as you meet certain criterias, you pull the money out, zero taxes.
Okay.
Huge.
That's why you get happy.
I get really happy. Yeah.
Okay, next step. What are we looking at?
So if we take our income that's coming in the door and we look at our expenses and we've got that deficit, then what we do is we take a look and see where do we pull from, and how that matters from a tax standpoint is the first scenario is going to be either very limited or small tax.
Okay.
The second scenario with pre-tax is 100% taxable, and the Roth is no tax.
Sure.
So why does that matter? Well, this isn't a lesson on tax brackets, but you know, as a married couple, you take a look at all of your income, you add that all up together, and then you take your standard deduction, typically, and let's say that number comes out to be $75,000. We look at the tax brackets and we see what the difference is if you were to pull money out of your retirement accounts that's 100% taxable as ordinary income, how much you can pull out of those accounts and still stay in those lower brackets.
Sure.
And just to give you an idea, there's two big jumps in the tax brackets. The first bracket is at obviously 0, but then the next bracket is at 10%, then it's 12%, and the first big jump goes from 12 all the way up to 22.
Okay.
And then we go from 22 to 24, and then the next big jump is from 24, then it jumps all the way to 32.
Wow. Okay.
I won't go through all of the numbers and how much you have to have in taxable income to hit each of those, but going back to the onion analogy, we look at what your income sources are, where the budget is, what the deficit is, and let's say that you've got room that you could pull out another $10,000 and still stay in that 12% bracket as a retiree. We'd pull out $10,000 out of your pre-tax, the IRA, that still keeps you in the 12% bracket. And let's say anything up and above that would put you in a 22% bracket. That's where we tap into the Roth.
Okay. So I think I know the answer to this, but if you could simplify it for me, if you have two retirees with the same amount of savings, why could they possibly pay different taxes?
True. And a lot of it is based on income. I know I've touched on this before, and it's not necessarily relevant here. But when you retire, it's based on the income you receive, not the assets that you have. And so in this particular case, it's kind of the reverse. It's like when you have all these incomes that are coming in, I could have somebody that's got, $1 million, retiree A and retiree B, they both have $1 million, but one of them elected to take their $4,000 a month retirement pension. That's $48,000 that they're receiving that the other one isn't receiving. So again, taxes are based on income, not assets. So if one has a lot more income sources that's coming in and the other one doesn't, the one that has a lot of income sources will pay a lot more in income tax.
Okay. Depending on where you live, is that a big difference? I mean, you can live in different states and there's different income taxes or no income tax, whatever.
Yeah, and I appreciate you bringing that up because oftentimes my mind always goes right to the federal government, which obviously is when I start talking about 12% jumping to 22%. That's all federal, but each state has their own. One of the things that's really gaining a lot of popularity is states are going to a flat tax. And quite honestly, I love it. I absolutely love it. I mean, you've got states that have no income tax. And I'm often asked, well, why would they not charge any income tax? Well, it's not that they're so flush with cash that they don't generate revenue other sources, whether it's property taxes or clothing taxes.
There's a different way.
So they get it other ways. But yeah, so each state is vastly different. And they range from 0% all the way up to, I believe the highest is right around 14%.
Okay.
So yes, you're right. That gets added on top of the federal income tax.
So taxes, there's a lot to discuss. You've touched, it feels like we've just scratched the surface, but it's very complicated. And sometimes even when you're explaining it, we can get lost in what exactly you're explaining. So when folks are heading into that retirement age and they're looking at taxes, what would you like them to take away from this episode?
I think the biggest takeaway from this episode is that taxes make a big difference when you retire, and you do have choices. And once you retire, you can control to a certain extent how much taxes you are going to pay. I think in the next episode, maybe we should have a little bit of a discussion about the accumulator, maybe at your age or your stage, I should say, and why it matters. And if you remind me, in the book, I talk about a story about borrowing money from your rich uncle. And I think that pertains to our younger audience that's the accumulators, and I want to share that with them. But I think the biggest takeaway today is just that when you're retired, you have lots and lots of choices. And oftentimes when you're meeting with your accountant, depending on how involved or how active you are with your accountant, oftentimes they're simply reporting the data, this is what you owe, as opposed to doing a little bit of strategy before.
Sure.
Now, if you have an accountant and they're proactive, that's great, and you've hired them to be proactive. But oftentimes, people are like, well, this is what my income was. What do I owe in taxes?
Sure.
And they may have pushed into the 22% bracket. We touched on it last episode about taxability of Social Security, and that's a huge thing because a lot of times people focus just on that 12% bracket, but what they miss sometimes is that all of a sudden now half of their Social Security becomes taxable. So that factors into taxes also. So
you touched on it briefly as well about the Roth. And when I hear this and you look at the retirement and the tax implications or lack thereof, so can you just reiterate to those who are maybe a little bit younger watching in that accumulation phase why it's so important in your mind to contribute to a Roth IRA?
Yeah, because I think the biggest reason for contributing to a Roth IRA, and there's, in fact, I think we're going to save this for next episode. I'm going to answer your question, but there's 3 ways to get money into a Roth account, which I do want to talk about next episode.
Sure.
And I think it's important, and that applies to everybody, whether you're 25 years old or whether you're 75 years old. I do want to touch on the 3 ways to get money into a Roth account. But to answer your question, why is it important? One of the biggest uncertainties when you retire is what tax rates are going to be.
Right.
For me in my 50s, there's a chance that we're going to see them go up in the next few years. Probably not, because it just the sunset basically, with the big beautiful bill that got passed, it goes back, and it basically, somebody asked me the other day, how long is that for? And I said, well, they say it's permanent, but you know how long permanent is in the government.
Right,
They can change it at any time. But my point is the likelihood of tax rates changing drastically in the next few years is unlikely. But in your lifetime, I'm going to pretty much tell you there's a likely chance. Now, my guess would be, based on where we're at as a country and the debt and everything else, it's going to be higher. But, Kamie, I can't tell you if it's going to be double or 10% higher. To answer your question, that's where the Roth is huge, because it takes away the uncertainty of what future tax rates are.
Yeah.
And we'll touch on it next week. The big element of Roths are, you don't get into a Roth for free. It's not like you get the free benefit of it. It's you either pay taxes now on that money or you pay it later. And your follow-up question, which majority of Mars, which is better, depends on the scenario. And again, we can touch on that next week too.
It depends. All right, fantastic. Thanks so much, Dan. Appreciate it. Thanks to you for joining us this week and learning a little bit more about taxes and what you should be considerate of as you do head into retirement and planning for the rest of your future. Thanks again. We drop a new podcast every week. We thank you for joining this week. You can always follow along wherever you watch your podcasts. Thanks again. Have a great week, everyone.
Fortress Financial Group LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Fortress and its representatives are properly licensed or exempt for licensure. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All indexes are unmanaged and may not be invested into directly. Investing involves risk, including loss of principal.